It's clear that the new Basel III regulations are designed to make individual banks safer by forcing them to retain more capital and to limit their leverage. One of the interesting side effects Basel III is going to have, though, is that it will most likely prompt a flurry of M&A deals throughout the banking sector. This may seem perverse at a time when banks are supposed to be retaining more capital, yet I believe it may actually be the only way forward for those banks currently falling short of the Basel III requirements. Banks which are stock market listed can always look to the stock market for public placements in an effort to raise further capital. However, to agree to this, existing shareholders will have to be sold a pretty good growth story before they consent to diluting their shares. This is where a solid, sensible acquisition will make great commercial sense. I therefore think we shall see a string of capital raising exercises conveniently disguised as acquisition fundraisers. The funds raised can then be used for the dual purposes of an M&A transaction and helping to meet Basel III requirements. We've seen a few instances of this already. Expect to see more from now on. The problem is, where do you look for acquisitions that are strong enough to support fundraising on this scale? Western assets in low growth economies will typically not offer a sufficiently attractive growth story, meaning there may be a stampede for those overseas assets which do. Not all domestic assets will be unattractive though. The earnings generation capacity of certain fee-based banking activities, for example, are less affected by Basel III. These include transaction banking in the corporate banking sector, payments and card processing in the retail banking sector, and M&A advisory in the investment banking sector. Therefore, I believe that any available assets in these areas are going to be at the center of some fairly major M&A tussles. Larger banks will likely try to muscle in on these areas, at the expense of small and medium-sized banks who will struggle to compete with the economies of scale which the larger players can offer. The other side effect of Basel III will be the degree to which a shadow banking sector emerges. With long-term, asset-based financing now more expensive for regulated banks, few will be keen on taking such debt positions onto their books. Therefore, it will be left to the capital markets or less well-regulated alternatives, such as pension or sovereign funds, to plug the gap left by the banks.